In the halls of power in Washington, a seismic shift is underway, fundamentally reshaping the landscape of global trade. The era of patient diplomacy and painstakingly negotiated treaties is being decisively replaced. The United States is now shaking up the global economic order not with multilateral agreements, but with a series of blunt, unilateral demands. This new doctrine represents a stark departure from the post-World War II consensus that America itself championed, an order built on institutions like the World Trade Organization and a shared belief in free and open markets. Today, the language of trade is no longer about mutual benefit and compromise, it's about leverage and coercion. The primary instrument of this new policy is not the negotiating table, but the official letterhead of the U.S. Treasury. Secretary Janet Yellen has been dispatching formal communications to finance ministries across the globe. These are not friendly overtures. They are stark directives outlining America's strict, non-negotiable terms for trade. The message is clear: align with Washington's economic and geopolitical priorities, or face crippling tariffs that could sever your access to the world's largest consumer market. The implicit threat is that access to the American economy is no longer a right, but a privilege, one that is conditional on adherence to a new set of American-made rules. This marks a sharp and deliberate break from decades of multilateralism. For over 70 years, the U.S. positioned itself as the anchor of a rules-based international system, promoting stability and prosperity through shared norms. This new confrontational era in U.S. economic policy signals an abandonment of that role. Analysts suggest this pivot is driven by a complex mix of factors: a response to China's meteoric economic and technological rise, and deep-seated domestic anxiety over the hollowing out of America's industrial base. The policy aims to reshore critical supply chains and protect American jobs, even if it means dismantling the very globalized system that once promised unparalleled efficiency. These letters are not suggestions, they are ultimatums, plain and simple. They make access to the vast U.S. market entirely conditional on following Washington's rules. At the heart of these demands is a strategic imperative. Countries are explicitly told to limit, and in some cases sever, their technology ties with China. This goes far beyond simple trade goods. The restrictions target the foundational technologies of the 21st century: semiconductor manufacturing equipment, 5G infrastructure from companies like Huawei, and advancements in artificial intelligence and biotechnology. The penalty for non-compliance is severe, the risk of tariffs as high as 50%, a rate designed not just to penalize but to prohibit, effectively forcing a complete decoupling from specified Chinese tech ecosystems. The timing of these demands is ruthlessly strategic, often coinciding with major international summits like the G7 or sensitive political moments in target countries, all to maximize diplomatic pressure. This has placed many of America's closest partners in an impossible position. Some allies, particularly those heavily reliant on the U.S. security umbrella, quietly comply, beginning the painful process of reorienting their economies. But many others, especially in Europe and Asia, are caught between a rock and a hard place. A country like Germany, whose manufacturing prowess depends on both American markets and Chinese supply chains, faces an existential economic dilemma. This high-pressure campaign is creating fractures within long-standing Western alliances. Faced with these stark choices, a growing number of nations are refusing to pick a side and are instead actively diversifying their trade relationships. They are turning to a coalition of emerging powers that offers an alternative vision for global commerce. The primary beneficiaries have been China, India, and Brazil, the core of the expanding BRICS bloc. The recent inclusion of major energy producers like Saudi Arabia and the UAE, along with other strategically important nations, has transformed BRICS from a talking shop into a formidable economic counterweight. This expanded group now represents a significant portion of global GDP and population, offering markets, capital, and resources without the political conditions imposed by Washington. This strategic realignment is accelerating a far more profound trend: de-dollarization. Washington's hardline stance, using market access and the dollar system as weapons, is pushing countries to build a parallel financial architecture. We see this as Southeast Asian exports to the U.S. face uncertainty, while their trade with China surges. African nations, long dependent on Western aid and investment, are forging new, dynamic partnerships across the global South. Crucially, these new trade flows are increasingly being conducted outside the U.S. dollar. China and Brazil now settle trade in their own currencies. India is buying oil from the UAE in rupees. The BRICS nations are actively exploring a common payment system, a direct challenge to the SWIFT network. This isn't just about trade, it's about redrawing the entire global financial map. This new dynamic is forcing even traditional US allies like Saudi Arabia to make tough, pragmatic choices. For decades, the US-Saudi relationship was built on a simple pact: American security guarantees in exchange for stable oil markets. But today, China is Saudi Arabia's largest customer, and the kingdom's ambitious Vision 2030 plan is deeply intertwined with Asian investment. They are now forced to perform a delicate balancing act, maintaining old security ties with Washington while embracing the new economic realities offered by the East. The result is a fundamental and perhaps irreversible shift in global alliances. The world is rapidly adapting to this new, more contentious environment. A multipolar world is no longer a theoretical concept, it is the emerging reality. We may be witnessing the end of a single integrated global economy and the beginning of an era defined by competing economic blocs with distinct rules, standards, and currencies. Washington's aggressive new doctrine, intended to secure American primacy, may ironically be the catalyst that solidifies a world where the US is no longer the only game in town. For decades, the global economic stage was dominated by the G7, but the script is being flipped. A seismic shift is underway. The BRICS bloc has now officially surpassed the G7 in its share of global GDP, measured by purchasing power parity. This isn't just a statistical milestone, it's a symbolic crossing of the Rubicon, and the gap is widening, accelerated by a historic expansion. Nations like Saudi Arabia, the UAE, Iran, and Egypt have joined, bringing vast energy resources, strategic waterways, and immense demographic weight. Their inclusion transforms BRICS into a formidable geopolitical force, representing nearly half the world's population. This gravitational pull is rerouting the arteries of global commerce. Traditional trade routes are now being challenged by new South-South corridors. This economic realignment is the engine for one of the most significant trends of our time: de-dollarization. For nations seeking to insulate themselves from US foreign policy, moving away from the dollar is no longer a debate, it's a strategic imperative. It's about reclaiming monetary sovereignty and reducing vulnerability to sanctions, which have been increasingly used as a tool of statecraft. The evidence is mounting. India and the UAE now conduct large-scale trade using their own currencies, the rupee and the dirham. China is pioneering the future of money, settling energy deals with its digital yuan, bypassing traditional financial plumbing. Russia, facing sanctions, has pivoted its energy exports toward China, settling in yuan and rubles. Each bilateral agreement, each non-dollar commodity trade chips away at the foundation of the dollar's supremacy. This is a direct challenge to the exorbitant privilege the US has enjoyed for nearly a century. While the old guard grapples with sluggish growth, these emerging economies show remarkable resilience. Investors are redirecting capital towards the bustling financial districts of Shanghai, the dynamic tech hubs of Mumbai, and the resource-rich markets of Sao Paulo. They see what the data shows: youthful populations, a rapidly expanding middle class, and fervent adoption of digital technologies, all pointing towards a future of sustained growth, increasingly decoupled from the economic cycles of the West. The great irony is that the post-World War II global architecture, designed by the United States at Bretton Woods, enabled this shift. The World Bank and IMF fostered the development that empowered these nations to now seek a more equitable seat at the table. But as Washington increasingly relies on unilateral tools like tariffs and sanctions, these rising powers are not just complaining, they are building. They are constructing a parallel financial universe, with institutions like the New Development Bank and alternative payment systems designed to operate beyond US oversight. The rules of global power and trade are being fundamentally and irrevocably rewritten. In an effort to protect domestic industries, the United States has turned to tariffs, a classic tool of economic protectionism. The logic seems simple: make foreign goods more expensive to encourage buying American. However, this strategy is a double-edged sword. The very policies designed to bolster the American economy are now creating a complex web of negative ripple effects at home, touching the lives of everyday citizens and challenging the nation's financial stability. The most immediate consequence is felt at the checkout counter. Tariffs on imported goods are passed directly to consumers, fueling inflation and shrinking family budgets. This forces the Federal Reserve to raise interest rates, slowing the economy. The blowback extends beyond our borders. Nations targeted by U.S. tariffs inevitably retaliate, hitting key American exports. The agricultural sector is often the first casualty. Farmers who rely on global markets find their livelihoods at risk, a painful paradox of a policy meant to protect American industry. Simultaneously, a seismic shift is underway in global finance. For decades, the US dollar has been the world's undisputed reserve currency, granting America what's called an exorbitant privilege. But this long-standing order is now being challenged. The BRICS nations are actively building parallel financial systems. By settling trade among themselves in their own local currencies, they are strategically insulating their economies from US monetary policy and the powerful reach of American sanctions. As this de-dollarization trend accelerates, the fundamental global demand for US dollars is set on a course for a slow but steady decline. This decline has profound implications. Much of America's massive national debt is held by foreign nations who buy US Treasury bonds. If the world needs fewer dollars, there's less appetite for these bonds. To attract buyers, the US must offer higher interest rates, making its debt more expensive. This squeezes the federal budget, forcing painful choices between domestic programs and paying interest. This also erodes geopolitical power. The dollar's dominance is the bedrock of US sanctions. As alternative payment systems emerge, this leverage evaporates, weakening a key tool of American foreign policy. All these threads, domestic inflation, trade wars, and the strategic rise of BRICS, point to one conclusion: global economic power is shifting. The unipolar moment of absolute American economic influence is fading. The US must now prepare for a world where it relies more on diplomacy than on economic coercion. A multipolar financial order is no longer a distant theory, it is the emerging reality of the 21st century, and American influence is at risk. We're at a crossroads. The era of US-led globalization is fracturing. Will America's hardline tactics restore its dominance, or accelerate the rise of rival economic centers? BRICS faces its own challenges. Can it become a true alternative, or will fragmentation prevail? Developing nations must choose balance both sides or pick a camp in a new economic Cold War. The choices made now will shape the global economy for decades. The old order is breaking apart, and what comes next is still uncertain. The story of the New World economy is just beginning.